Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lumen Technology stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lumen Technologies is a telecommunications company. It is the second largest U.S. communications provider to global enterprise customers, behind Comcast. It has customers in more than 60 countries. The company is headquartered in Monroe, Louisiana, and was founded in 1930. It started trading in '72 and can be found on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, and Sao Paulo Stock Exchange. It is a member of the S&P 500 Index. On September 14, 2020, CenturyLink announced that it had changed its name to Lumen Technologies. The stock ticker also changed from CTL to LUMN. CenturyLink will continue to be the customer-facing brand for traditional copper-based services. Fiber-based products and services will use the brand Quantum Fiber. A copper-based internet connection is the standard connection type that has been used for over 100 years. The reason CenturyLink merged with Level 3 in 2016 was to capitalize on the more advanced fiber technology. The combined company later changed its name to Lumen to get a fresh start and to hopefully move away from CenturyLink's past struggles. Lumen has laid down 450,000 miles of fiber network. They also received a large amount of tax subsidies by doing this. In its 2021 second quarter report, the company mentioned it received board approval to buy back up to $1 billion of its stock over the next 2 years. Let's get started with the model. This is a large cap company, 13 billion market cap. They're trading at $12 a share, and they have 1.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do generate a lot of free cash flow, 2.8 billion up to 3.9 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. We'll look at the income statement later to figure out why. Revenue is the sales for the company, and that's been dropping from 23 billion to 20 billion, but still 20 billion is a lot of revenue. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 2020 revenue, and only 25% of it came from consumer sales. Their largest was enterprise at 5.7 billion. Then 3.8 billion in wholesale, 3.4 billion in international, and 2.6 billion in small and medium businesses. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's been decreasing each year. Below that is their operating expenses, and depreciation is their main operating expense. And then below that is operating income. Even with their lowest revenue, they have one of the highest operating income years. So their margins are improving and they're becoming more efficient. The hardest part about generating the revenue is to build the infrastructure and lay down the cables. Once that's all set, which takes time and is very expensive, but once it's all set, then they just collect revenue. So their operating expenses were probably higher in prior years because they were doing more of that infrastructure, and it seems to be coming down in current years. The biggest issue with this company is the amount of debt they have. They paid 1.6 billion of interest on their debt in the trailing 12 months. But that's $600 million less than 2018. So the new CEO is doing a good job at refinancing debt at a lower rate and also paying down a lot of debt each year. And the bottom line of the income statement is their net income, which is negative every single year. The company's biggest expense is depreciation because they spend so much in CapEx. But another reason they have negative net income is these large goodwill impairments. You can see they have negative 2.7 billion in other income and expenses, negative 6.5 billion, and negative 2.7 billion. These are all goodwill impairments. So when a company acquires another company, they generally pay a premium, and the amount they pay above that company's value is booked as goodwill on the balance sheet. And goodwill is an intangible asset. It really doesn't have any value. But in future years, if the company deduces that the value of the acquisition should have been less, then they reduce their goodwill on their balance sheet and pass through a loss onto the income statement. But it's a non-cash item. The cash occurred years ago when they acquired the company, but they're taking the loss in the current year. So if these goodwill impairments didn't occur, they would have positive net income each year. So you can see they have negative net income every year. But let's look at the statement of cash flows, see how much cash flow they generated. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they generate a lot of cash flow, $6.5 to $7 billion. Even though they reported negative profit, they're actually bringing in a lot of money. And they're constantly building out infrastructure in different locations so they can develop communication networks in those areas and bring in revenue. They spend $3 to $4 billion a year on CapEx. But even after spending all that money, they still have about $3 billion left over each year to do whatever they want with. They do pay a really nice dividend, but they're reducing their debt a lot each year. They reduced it $1.7 billion in 2018, $700 million in 2019, and $3 billion in 2020. That's really important. They need to continue reducing their debt because that's a really heavy burden on this company. This is the equity section of their balance sheet, and they raised $20 billion from selling stock, and they lost $7 billion from running their business. So you can see they did have positive retained earnings from 2006 to 2014. Then it turned negative. Then they were running a small positive for a while, and then a bigger positive, and then they ran into a big negative. Once they tried to get into fiber optics and acquired other businesses, it really drained their cash flow. But I think they'll eventually bring it back to positive retained earnings once they reduce their debt load and continue growing their fiber optics and enterprise segment. Let's look at the capital structure. $11.7 billion of equity, $31.6 billion of debt. That's a ton of debt. They're 27% equity, 73% debt, and their weighted average cost of capital is 8.89%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $36 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $34 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of $30. They're trading at $12, so they're trading at a 60% discount. It's a strong buy according to the model. The company originally projected their free cash flows to be between $2.8 and $3 billion. Then they revised that to 3.1 to 3.3 billion. I took their lowest number, 2.8 billion, and I reduced their free cash flows. I didn't grow them. I reduced them 5% a year. And even with this bearish estimate, I'm still coming out with a stock price a lot higher than they're trading at. Because they have so much free cash flow they're bringing in now, I'm not even asking them to maintain it, just to be 5% less a year, and the stock is still undervalued. But people don't buy the stock based off of the intrinsic value of the company. People buy the stock based off of how they feel about the company. And a lot of people have a negative connotation towards CenturyLink because its main focus for so many decades was on landline, which is pretty much an obsolete product. It will be obsolete probably in the near future. But the company has pivoted by the acquisition of a fiber optics company. But there is immense competition in this industry, especially newer companies that are just working with the newest technology. They don't have all this old technology in addition to the new technology like this company does. Simply Wall Street is pretty close to me. They value the company at $32 a share. 6 analysts priced this stock and the average price target was $12. This is where the stock has been trading the last 37 years. So you can see it peaked at about $50. It used to be a pretty popular stock at one point, but it's really struggled with all this competition. This is where the stock has been trading the last 12 months. So there was a short squeeze that really pushed the stock price higher, and then it came down right away. And then it was on a nice steady incline, but lately it's on a steady decline. So this is a tough stock. Not a lot of people really have faith in this company. And they pay a great dividend, 8.27%. They cut their dividend from 54 cents to 25 cents. But since their market cap has come down so much, their dividend yield still looks amazing. We cannot look at their payout ratio because they have negative net income from all those goodwill impairments. But dividend payment over free cash flow is a better tool to use to figure out if the company can maintain that dividend payment. And they pay out 31% of their free cash flow in dividend payments. So that means they have 69% left over to pay down debt, which they really need to do. And they pay a great dividend, 8.3%. Their industry average is pretty high at 5.9%, and they're the highest in their industry. I found this chart on the top 10 dividend stocks in the S&P 500, and this is in the first quarter of this year. So Lumen was 4th on the list at 7.49%. The stock has actually come down, so now it's 8.27%. Carnival is 3rd on the list, but I crossed it out because they cut their dividend. Same thing with Credit Corp, they cut their dividend. AT&T didn't cut its dividend, but they will cut it soon, so I crossed them off as well. So this company pays the 3rd highest dividend in all the S&P 500 companies. So this is a great stock for people who like their dividend payments. The stock is not too volatile. It has a beta of 1.06. And it's gone up only 12% in the past 52 weeks, while the S&P went up 32%. The 52-week low was 850, the high was 1660. And the stock is on a decline, so it's trading below its 50-day and 200-day moving average. And this is a really popular stock, probably due to the high dividend payment. 16 million shares were traded on average the past 10 days. Of the 1.1 billion shares outstanding, 1 billion are on float. 76% are held by institutions. And it has a pretty high short percentage. 9.4% of the shares are shorted. In the past year, the stock hasn't done too bad, up 19%. But in the past 3 years and 5 years, the stock has really struggled. Analysts are bearish on this stock, projecting their earnings to decrease 38%, their revenue to decrease 7%. Same thing with my model. I'm projecting their free cash flows to decrease 5% every year. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be at $7,900 today. That's a 22% loss. Vanguard is the biggest shareholder at 11%. Then the next 2 shareholders own 9%. Then Southeastern Asset Management and State Street. Let's look at their financial ratios. We can't look at the PE because they have negative net income. And look at that price to sales ratio, 0.7. That means their revenue is higher than their market cap. That's a really good price to sales ratio. They also have a really good price to book at 1.1. But they have $26.5 billion of intangible assets. So their tangible book value is actually negative. Their return on invested capital is decent at 7%. They can cover their interest payments 2.5 times. Negative ROE. And companies that generate a lot of free cash flow, they usually do not keep a lot of cash on their balance sheet because they know they have so much cash rolling in. Plus, they have so much debt, they rather pay down the debt than let the cash sit on their balance sheet so they can save on those interest payments. So they do have a current ratio and quick ratio below 1. They have $1 billion of cash and $2 billion of receivables. So even though their working capital is negative, meaning their current liabilities are greater than their current assets, they bring in a lot of cash flow, so they're not going to be too short. Even with the $1 billion dividend payment, they almost have enough funding to cover their operations. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 14 other companies in the same industry as Lumen, and if Lumen has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at their PE. They have the best price to sales ratio of all the companies. They have a good price to book. They have the lowest current ratio, but you could see a lot of companies in this industry have a current ratio below 1. Negative ROE. They have a ton of debt. That's a big issue with this company. 13 billion market cap, which is a lot smaller than the average in the industry. And of course, they pay the best dividend of all the companies. So to summarize, I have them trading at a 60% discount. But this company is having a really hard time getting away from its old image of being an outdated company that just focuses on landlines, something that's going to probably be obsolete soon. But they have a lot of infrastructure in place, and that has a lot of value. And even if you feel they cannot compete with the newer companies that have better technology, they still have a huge customer base and bring in a lot of revenue. And there's something to be said about that. I rank their free cash flows 8 out of 10, their revenue 6 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.